Hello, and welcome to the Geopolitics Explained podcast. Today, I'm going to delve into China's economic woes and some potential solutions that China could pursue. China's current export-led model is under pressure. Real estate overcapacity and falling housing prices are weighing on household wealth. Deflation is eroding demand and making debts harder to pay, and demographic issues in China pose long-term strain on the country. If China can't pivot from its export-driven economy to one of domestic consumer growth, it risks the middle-income trap and long-term stagnation. But China does have options. It's these options that I will explore in today's episode. Interestingly, I'm going to start on the other side of the Pacific with the United States. China's current economic issues have contributed to a plan. For an indication of what this plan is, I'd recommend listening to Scott Bessent. He has confirmed that the belief of the United States is that China can't change their global export model to one of domestic consumerism. This is why the United States has made the trade moves that they have, specifically with tariffs and export restrictions. Trump wants to limit the power that the export model gives China over other geopolitical actors. Trump also wants to boost US manufacturing. This is for self-sufficiency purposes, such as relying less on Chinese rare earths and boosting strategic reshoring. But it could also be so the United States can take some of the global export market share that China currently has a large grip over. Bessent has also discussed China and the middle-income trap. This is an economic concept that describes the situation where countries achieve middle-income status, but they struggle to transition to high-income status. This results in a period of stagnant economic growth. Now, if we look at China's economic growth data, you could immediately dismiss this, but there are some signs that China is struggling. Firstly, China has limited the release of some economic data sets. This could be a battle of information, since if the United States doesn't possess this information, then they don't know what economic battle they could be walking into against the Chinese. Or it could be the flip side of this, that China wants to hide potential economic weakness. Another issue arises when we look at the rate of price changes in China in the last few years. China has frequently seen months of deflation or falling prices. Specifically, the producer price index declined by 3.6% year over year in July, marking a sharp drop tied to weak demand and overcapacity. Headline CPI is also hovering around zero, but in May did turn mildly negative at 0.1%. Transport facilities, communication equipment, food prices, rent prices, crude oil, gas extraction, coal mining, chemical manufacturing, high-end hotels, and broader retail are all also seeing strong deflationary pressures. This is an issue for China. If they attempt to pivot from an export-driven model to a domestic consumption model, but prices are falling, psychologically, if people expect prices to keep falling, they will delay purchases. This will reduce demand even further and can lead to a deflationary spiral. Also, if prices fall, debt repayments become more expensive in real terms. For heavily indebted local governments in China, this is an issue. But the biggest issue is that if prices are falling and China wants to pivot to a domestic consumption model, the psychological issues, such as consumers delaying purchases, could limit the success of this pursuit. The impacts of deflation would also be felt beyond China's borders. If the world's second largest economy fell into a deflationary spiral, the shockwaves would spread to global trade, commodity prices, and investment flows. This pivot to a domestic consumerism economy in China is one that Scott Bessent doesn't expect China to be able to make. The Chinese ghost cities and their real estate woes are contributing here, Many of these buildings have boosted GDP growth in China in the past, but today they sit empty, bringing in no money and contributing to real estate deflation. Even for Chinese residents, falling home prices will reduce household wealth, which further impacts the potential pivot to a consumer-based economy in China. The real estate crisis will amplify deflation by crushing a major source of economic demand in China. In the longer term, this is also connected to China's demographic issues. The one-child policy has led to a male imbalance and high youth unemployment. With a declining population now seen in China and net negative migration, China will have to shift to address some of these issues. AI and automation will create ripples in the world of work, but if there aren't enough jobs for the youth in China today, these technological shifts could worsen this issue and fuel even deeper changes in the world of work, especially in China. The one-child policy also contributed to an aging population, which will worsen over time. This has seen some analysts, such as Peter Zion, claim that China is a decade away from collapse. This is a prediction that he first made in 2010, and despite his claim not coming true, there is clear strain here. In some families, one working-age adult could be caring for 2 retired parents and 4 retired grandparents. A system as pressured as this could one day grow more unstable. So, this sums up the issues that China currently faces, but as I've alluded to, they do have some options. If China is to get through these issues, it has to address the root causes of them. They do have the capabilities to do this, but what specific strategies could they pursue? First of all, China could restructure the debts of local governments and over-leveraged companies to prevent default risk from spreading through the system. Recapitalising key banks or firms can also stabilise the credit market and boost economic confidence. There is also how China deleverages its current high levels of local debt. Ray Dalio frequently discusses the concept that he calls a beautiful deleveraging. This is when debt levels are reduced slowly to avoid sudden shocks. If a careful pace was maintained, China could manage investment and consumption while lowering systemic risk in the pockets of its economy where it's present. China could also stimulate demand through targeted stimulus, which is something that we've seen recently. This could be via infrastructure spending or tax cuts that would boost short-term economic activity. It's worth noting that this could also help counter deflationary pressures that would support the transition to a consumer-driven economy. China could also enhance household wealth and access to credit. They could pursue social security and pension reform. Strengthening pensions and social security nets could reduce the strain on savings. A pivot in social safety nets and strong pensions would also mitigate the economic impact of China's aging population by shifting some responsibility from Chinese families to the state. Another strategy that China could pursue is more open capital markets. Stimulus could be directed towards the stock market. This could allow domestic savers to invest in Chinese equities and bonds, and could see savings diverted into more productive sectors. This could also provide tailwinds to innovation in China. The final point is that China could pursue balanced infrastructure investment. Focusing investment on areas with immediate economic or strategic value, rather than speculative building, would prevent overcapacity. This has been a key issue in China, and if investment is targeted well, a boost to productivity, stimulated demand, and long-term economic growth could arise. But despite all these solutions, there is the underlying challenge here that China's financial system was built for export-driven growth and expansion fueled by investment. Shifts in globalization are hurting the export model, and China's closed-off capital markets will eventually reach limits in domestic investment. This will require shifts in monetary policy, debt, real estate, general openness, industrialization and demographics. Specifically, a pivot to enhance household wealth, to pursue pension reform, and to incite domestic demand will require some shift of economic power from the state to privately owned businesses and households. This is a huge shift from China's export model that has fueled China's rise for the last few decades. In the last decade, we've seen China crack down on some of its biggest companies, such as Alibaba, when they have started to grow too big. Are the days of such intervention over? Another shift could also be seen in China's political system. The tourism sector in China is growing, more open, so a trend is starting here. But in terms of political aspects in China, such as capital flows, data, the private sector, and the internet, the state still has some levels of control. This control is seen as essential for political stability in China. I question whether this balance of control will slowly shift, with the aim of not creating too much noise in the Chinese system with the shifts that they pursue. I mentioned the beautiful deleveraging, which will also be difficult, since China also hopes for strong GDP growth. Naturally, cutting debt will mean spending less and investing less, which typically slows economic growth. This highlights the difficult position that China is in. But if China doesn't address these issues, the middle income trap could persist, as Scott Bessent predicts. But if China does navigate these issues, the tailwinds that it possesses could become undeniable. So, to conclude, the issue isn't feasibility. China could do this and so much more. The question is of political and structural trade-offs. Can China shift power without destabilising its political system? That's all for today. If you enjoyed this episode, why not leave a review on the platform of your choice? I've been Dylan. I'll talk to you next time.